There's a very interesting dichotomy going on within the economic data right now. Some of the data is okay. It says the economy is doing just fine. GDP right now expected for second quarter to be around 2.2% growth. Again, the economy is doing okay on the surface, but there's a lot of other indicators that suggest that, well, maybe not so much. And again, we take a look at ISM manufacturing and services are weak. Leading economic indicators are negative. So why this divergence? I posted this chart this morning on X. It's all tech spending. They did some analysis showing that ex-tech spending, the economy would be very close to recession. We've talked about before, all this data center build out, all of the push by technology companies, these hundreds of billions of dollars being spent into CapEx. You've got CoreWeave investing $100 million into Oracle, which is investing $100 million into NVIDIA, which is investing $100 million back into CoreWeave. And so you got this whole little circle going around of money flows of companies investing in each other, building stuff out. That's all providing for economic growth on the surface. But for the vast majority of the economy, there's a lot of weakness. So the question is which one's going to win out ultimately, and particularly as we go into next year, because Wall Street is betting on an economic resurgence, that all of a sudden this weakness that's in the rest of the economy is going to turn around and begin to reaccelerate. And maybe that's the case, but you need a catalyst for that. What's going to be the driver to get consumption and these type of things that kind of for the broad base of Americans to start growing again and get us back up? That tech spending that we've talked about here on the show, again, that's because there's a lot of monetary multiplier effect of that type of spending on the economy because it's more infrastructure, building out these data centers, etc. But it is having impact, and we are seeing it in the economic data, but it's a very bifurcated set of data. When we start talking about leading economic indicators, inverted yield curves that have now uninverted, typically a recessionary sign. Hey, there's no recession, but there's also no resurgence either. So it's just kind of an interesting thing because this all comes back down to earnings ultimately and forward valuations. And forward valuations right now just eclipsed the highest level we've seen since 2021. And that's now the second highest level on record going back to the dot-com crisis in 1999. So valuations are very rich as investors are continuing to bet that forward earnings are going to catch up with current valuations. In other words, justify the valuations that people are paying today for stocks. And particularly in some of the more high beta names, again, as we talked about before, a lot of risk on in the markets, lots of beta chase right now, and that's okay as long as everything remains kind of status quo. Any hiccup to this is going to be problematic as we kind of go forward. This is economic growth with and without tech spending, and this is kind of the point that I was making, is that you can see that 2.2% growth in the economy that's estimated right now is all coming from tech spending. If we didn't have that technology spending on AI data centers, etc., we would be much closer, if not actually pending kind of a recession.
Catch me daily on The Real Investment Show. The link is in the description.